First of all, thank you very much, everyone, for joining. For those that are new to 3IQ, 3IQ is a digital asset manager that launched the first Bitcoin and Ether exchange-traded products in North America, listed on the Toronto Stock Exchange. And we have been dedicated to the crypto asset class for since 2016. Excited today to talk about our ETHQ ETF, our Ether Staking ETF, and more importantly, Ether staking in general, what it means, why it's important, how it impacts investors, how they should think about staking from a risk-reward perspective, and all the fun nuances around that. So why don't we start with the most exciting part of the presentation, disclosures. If we flip to the next slide, we'll just hold on this slide for 10 seconds, and I think there's another even more exciting disclosures slide on the next slide. So why don't we flip over to that one? And here that one is. Of course, nothing that we do today is considered financial or investment advice. And with that, why don't we flip onto the next slide where I can introduce myself and pass it over to my colleague, Greg. Hi, everyone. I'm Christopher Matta. I'm the president of 3IQ Digital Assets US. I've been at 3IQ for the last three plus years at this point, and I've been in the digital asset industry professionally in the asset management space since 2017. Greg, why don't you do a quick intro and we can dive in.
Yeah, thanks for that, Chris. Hi, everyone. My name is Greg Benhaim, and I am the Senior Manager of Trading here at 3IQ. I joined recently this past July. Prior to 3IQ, I worked at a crypto hedge fund for 4.5 years, managing their market neutral portfolio. Have been actively in the crypto space since 2017. And we have some really exciting things here to discuss with you today during a very exciting time in crypto. So we hope you're ready for all of us.
And one disclaimer before we start, we want this to be as interactive as possible. There's a Q&A box through Zoom. You can ask questions in there as we go along, and I am going to try and make sure that Greg and I can try and answer those questions while we go through the presentation. Of course, we'll also have time for Q&A at the end, but if there's something related to a specific slide or topic that we're looking at that you want to ask a question about, please feel free to drop it in there. And one extra fun aspect of it, if you want to include your Ether public key, if you set up an Ether wallet and include your public key with the question, we're going to take a few of the top questions and send some ETH after the presentation to the people that ask the most interesting questions. So just a little fun additional exercise to try and get some really good questions from the audience. So feel free to drop those in the Q&A box as we go along. And with that, I'll hand it over to Greg to kick it off.
Perfect. So what is Ethereum for those of you who do not know? The simplest way to describe Ethereum is it's an open network that people want to interact with, and it requires the use of Ether, the native token on Ethereum, in order to interact with it. Now, who controls Ethereum? How are you able to interact with it? It's all done via smart contracts. So it's a decentralized network, completely open to the public, and there's no single controller or entity that runs the network itself. The best way you can think about Ethereum that resonates with me is you have the network itself and you have the token. And anytime you interact with the network, you generate a particular output. Whether you do a financial transaction, if I'm sending an asset from myself to Chris, that is an output. And in order to generate that output, you need an input, which is Ether. So I interact with this network. Well, the cost of it is a small fraction of Ether, and then I generate some form of output. Now, the key difference between Ethereum and any other network is the decentralization of it, which is what leads to all the decentralized applications currently being built on it that Chris is going to talk to you about in a short little while. You have everything from decentralized finance on there. You have lending that's able to be done on a decentralized manner. You can take it one step further, if you will, And you can create ways to, you can create ways to do credit rating systems with each person you're interacting with on the network itself, so that you don't need a bank or any central intermediary to review every single transaction. Chris, do you want me to show the top 5 applications right now on Ethereum?
Yeah, that would be great. So this page that we're going to pull up here is an interesting dashboard that kind of just illustrates some of the different use cases that are built on top of the Ethereum network. I think sometimes it's hard for people to wrap their arms around, what a smart contract platform really means. And like Greg mentioned, some really simple use cases are things like lending. Instead of lending to people through a trusted intermediary like a bank, where obviously banks have a lot of overhead, there's a lot of fees associated with that. Peer-to-peer lending via smart contracts on a network like Ethereum is something that's been very popular over the last few years. It's part of what's called the DeFi ecosystem, the decentralized financial ecosystem. So if I want to lend Greg, value, I can lend assets to Greg via the Ethereum network, via different protocols that are built on top of it. And there's an automatic system around how that lending is collateralized, how the margin is handled. In the case that there is not sufficient collateral, those loans automatically get closed out, and the smart contract returns the assets to me, being the lender, and Greg being the borrower. So that's just a simple use case. And like Greg mentioned, there's much more complexity that can be built on top of that, from credit rating system, like decentralized credit rating systems, to a lot of other things that you've seen, I'm sure, on headlines and in the news. Things like on-chain property rights, like the ability to actually own a digital item and transact that digital item, whether it's a collectible, like a piece of art, or an in-game, in like a video game, an item in a video game that you buy and sell. That's something that obviously already has a clear real-world use case. And a network like Ethereum enables the ability to create these new innovative marketplaces on chain in a decentralized way without having to have banks or other trusted intermediaries.
Thanks, Chris. And just to emphasize this, these are the total values that are locked on all these different subcategories on Ethereum. So you can see lending, the current lending market, there's about $30 billion on Ethereum. DEXs, which are decentralized exchanges where you can trade different assets, there's also roughly $30 billion, et cetera. And you can see, obviously, the market continues to grow and continues to grow.
Well, one question that we actually just got was, what is they asked business volume on the Ethereum network, but I think some of that page that Greg just had up, it actually shows some of those volumes, but they are not insignificant. These volumes can be really large. You're talking about $100 billion that's going through value locked across lending and decentralized exchanges and some of these other DeFi use cases. That doesn't include other types of use cases like transaction volume around on-chain collectibles and things of that nature. So it's hard to put like a one volume number on there because there's a lot of different use cases, but you can look, this dashboard here from the block provides looking at a variety of different use cases, but it's in the billions, if not hundreds of billions of dollars of transaction volume that's happening on the network, which is substantial, and it's grown and it's a lot more mature than it was in the past.
Moving on. So we've introduced Ethereum, but what is Ethereum staking? How is the network secured? I'm sure some of you know about Bitcoin, and it has this complex proof of work system that takes up a lot of energy, and people are saying it's causing issues with global warming. We're going to get away from that. Ethereum recently moved to a proof of stake network. Now, what does that mean? In order to secure the network, there are these validators, essentially these entities that hold 32 Ethereum and are running this software that validates every single transaction that is on the network. Currently, there's roughly, I think, 500,000, in between 500,000 and a million validators. So you can see the scale of how decentralized the actual network is. And so one of the benefits from moving from a proof of work to a proof of stake network is all of a sudden it becomes a little bit more scalable because the energy consumption is significantly less. Now, if you think of Ethereum and what we just explained, you have all these transactions that are happening. I'm lending money to Chris. I'm buying this digital piece of artwork. I'm issuing my own property rights for my home on the network. If I'm doing these three transactions and there's millions of people interacting with the network at the same time, scalability is a huge, huge, huge factor, which is why one of the main reasons they migrated to a proof of stake network. One of the also interesting things when you think it's the same concept for proof of work, but the concept of an open network is everyone can participate in securing the actual network, which is what us at 3IQ with our institutional grade product are doing. Is we found a way to generate yield through the staking mechanism on Ethereum, but we're also contributing to the network by running our own validators and securing and validating every single transaction that passes through the Ethereum network.
And I actually got a question here around the potential risks of switching to a proof of stake consensus mechanism. And I think Greg hit on some of that in the description, but there's this trade-off between security and decentralization and scalability of a network. So to Greg's point, moving from proof of work, which takes a lot of energy consumption, to proof of stake, which is a much more scalable a consensus mechanism. Essentially, you're staking your assets and validating transactions to ensure that you remain a good actor. And if you're a bad actor, those assets will be slashed, you'll be penalized, and that's how they ensure that the transactions are being validated on the network. But moving from proof of work to proof of stake, that helps increase the scalability and the throughput of transactions versus proof of work, that energy consumption that that Greg talked about. I also have, there's a few questions that have come in with ETH addresses, so that's amazing. Great job. And one of those questions is, what are some of the eligibility criteria for someone to borrow through ETH? This comes from Chris. So we mentioned DeFi before and lending on chain. The beauty of this is there actually are no eligibility criteria. It's anyone can lend to anyone else. There's a pool, but there are certain rules embedded in the smart contracts of these lending protocols. So the lender or the borrower needs to post certain amounts of approved types of collateral. And in the case that that collateral drops below certain pre-agreed upon values, loan to value percentages, the loan will automatically be closed out and the collateralized assets will be returned to the lender. But to the point that Greg made earlier, that's like the simplest version of a lending protocol like this on chain. Truly decentralized, peer-to-peer, there's no eligibility criteria. But you could take that a step further and try and build a more sophisticated system where you have on-chain credit ratings that look at, am I a good actor? How has my history on-chain been? Do I pay off my loans? Have I defaulted on loans? Have loans been closed out against me? Am I meeting my margin requirements? And those different variables can determine what my on-chain credit rating looks like. And then I may be able to get preferential type terms while lending on chain. That is more nascent. That there's protocols that are trying to develop more sophisticated lending platforms. But the beauty is decentralization makes it accessible to anyone. So I think that's the answer to that question.
And just to add a little bit to that, it adds a lot of capital efficiency and quality, right? Nobody knows, okay, I'm loaning to Greg Benhaim or Chris Matta. They know that they're lending to wallet ABC. Wallet ABC has the following track record. And that's only when the credit rating system is done. Before the credit rating system, it really doesn't matter what wallet they're lending to. It's all controlled via a smart contract. You can lend to a person halfway across the world and you have no idea. the code is what is automatically going to liquidate a position whenever it's below a certain margin requirement. It really just creates equality for every person across the globe.
And there's another question that's related from apologies if I get this name wrong, Make, which is how will ETH affect the future of banks' ability to still be relevant? And he also included a public key, so thank you for that. And we will include you in the ETH giveaway. But it's a good question. I think the transition, obviously, from centralized banking, which is a well-established and highly regulated industry, to a new technology like ETH and like crypto assets, which create this more decentralized financial infrastructure, that is a process that takes a long time, right? Bitcoin is the first iteration of a decentralized financial application, which is a decentralized store of value. That's been around now for over 15 years. And so this is a really long-term time horizon that this transition is going to take place. I think many banks, it looks like, are actually leaning in towards blockchain technology, maybe not as decentralized as some of these DeFi protocols are. But it definitely is an alternative system that's democratizing finance in a different way on a global scale, where people all over the world can access US dollars and treasury yield and peer-to-peer lending, even if they're in countries that don't necessarily have a super robust banking system, or maybe don't have or have a less trusted government or central bank where they're concerned about inflation. This is definitely an alternative direction that people can essentially opt out of the traditional financial system and use a more decentralized financial system. So that's a powerful thing. Competition is good. I think long-term, hopefully it forces banks to continue to evolve. And I think there will likely be use cases for both. Some people may want centralized banking for certain types of transactions, and some people may prefer a decentralized infrastructure to do some of these transactions. So it's a long-term thing. It's not going to be one or the other, I don't think, at least for a long time. But it's really exciting to see this technology continue to grow and be adopted on a global scale.
I think you hit it right there, in that it's forcing banks to innovate, and it's forcing banks to eventually, they're going to be reducing their fees. They're going to be offering different services. So I think it's a complementary service rather than one that's going to completely destroy the banking system. It's going to take a lot of time.
Yep. All right, let's keep rolling. We have a bunch more questions that are related to the funds. I just want to let everyone know that we're going to get to them in the back half of the presentation when we start talking more about the funds.
Yeah, so real quick, just talking about how do you become a validator. Again, anyone can become set up a validator and run their own node. All you have to do is download Ethereum's consensus layer client and run the software. You also do need 32 ETH. Currently, that's about $100,000 US. So you may slightly, that may be a bottleneck for some people. But you're running the consensus layer client, the software in the background, with your 32 ETH deposited in that validator, and you're up and running. And you're all of a sudden testing every single transaction that's done on the network. You're looking at every single block, and you're receiving a reward every epoch, which is 6.4 minutes on the Ethereum blockchain. You receive a small reward for taking part of the consensus layer.
And I think it's worth mentioning, like Greg said, there's a variety of flavors to setting up a validator or staking, and we're going to talk about some of these in a lot more detail. But it can be from running the client software on your own computer to working with a third party. There's obviously due diligence and potential risks to working with a third party to ensure that that they are keeping the software up to date and having the appropriate amount of uptime. But those are challenges that you deal with even for running the software on your own. If you have certain amounts of downtime, or you're not upgrading your software quickly enough, that's where potential risks around slashing could potentially reduce the return that you generate on the ETH that you are staking. So there's trade-offs for every step of the way. You obviously have to be a little more tech savvy and a little more confident in doing it yourself. And there's that 32 ETH burden, which is a high bar for most individuals that may not have 32 Ether, but still want to stake and support the network. So that's where there's third parties, whether it's through like a crypto exchange or trading platform that may offer it, or a specific validating service, a staking or validator service provider, or like a 3IQ, an asset manager that may bundle staking into regulated financial products, which we'll talk about in a little while. So there's kind of different flavors to actually become a validator and help support the Ether network.
Something I also just want to point out, if you look at the chart on the right, since staking was launched, it's pretty much up and to the right, meaning more and more people continue to secure the network, continue posting their 32 ETH and validating all the transactions on the network. What's really important there is it hasn't been all sunshines and rainbows in the past 3 years. You've gone through a significant bear market in crypto, but that hasn't discouraged people from kind of improving the network, securing the network, and constantly innovating on the network itself. So this is just a workflow of how the validator rewards are paid out, and we'll actually show you a couple of our the validators that we're running ourselves, and you can see it all on chain. Anyone can see that, so I think that'll be an interesting exercise. But effectively, this is just continuing what we discussed previously. Any business or individual with 32 ETH can stake it using the consensus node, and they start validating many transactions, and they're paid 2 sets of rewards. There's a consensus reward, which is what every single validator is paid every epoch. It's the same amount, more or less, for every single validator. Then there's also a fee reward. So in every single transaction, they're grouped together and they form a block. And each block has a fee reward associated with it. Now, if we tie it back to the beginning where I said Ether is the input and it generates an output on the network. Let's say we go to Chris's example of lending. If someone, for some reason, decides they're going to borrow assets at 100% interest rate on an annualized basis, and they're willing to lock their funds for a year, all of a sudden, that's a very attractive output that people are going to be racing to take advantage of that. So they may be willing to put more of an input, more ETH, to win that transaction. So let's say they decide to put, okay, I'm going to put 10 ETH, a crazy amount, $30,000 worth. If I am the validator that proposes that transaction in that block and it's approved, my validator is the one that collects all the reward, the transaction fee for that particular transaction. So I'm just going to go real quick into 2 examples of validators that we have. And of course, the screen is partially blocked, so give me a sec. This one is a really fun one. This was, we called it the first jackpot we hit. We actually approved a transaction where there was a 12.4 Ethereum transaction fee associated with it. So what's cool about this, you can see we deposited our 32 ETH. The total reward since inception, which is about 120 days, is 12.72 ETH. So we've earned on this validator over 33%. Here's the 7-day APYs, the 31-day, and then the 365 days. So you can see it's heavily skewed because of that 12.72% ETH reward. These are all the consensus rewards that I mentioned previously. So every single validator that's validating the network is receiving this, and Wave, for those of you who don't know, is 1/100 millionth of an Ethereum. So for epoch 266,660, we received 0.00009735 Ethereum, and that just keeps moving along. Every 6.4 minutes, we continue to receive roughly the same amount there, and if we're lucky enough, we also receive the transaction fee if our validator is the one that proposes the block. Now, given that the products have roughly 2,500 blocks, 2,500 validators, the probability of us being the one that proposes the block significantly increases than if you were one individual validator running it yourself. And here's just a chart of the daily income that the block produces. The really cool thing about the validator produces, excuse me. The really cool thing about this is you can look up any single validator on the network. We can look up ours. We can look up the best performing ones. We can compare the performances. We can see what the percentage of the uptime is. It's all completely open source. Anyone can access this. Anyone can look at how their performance is.
Yeah, and if we go back to the slide, we actually got a question here from George, which was, what is the value of the validator rewards annually? And I do want to make it clear, based on the level, like Greg mentioned, based on the transaction volume that's going through the network, based on how many validators there are on the network, the yield fluctuates based on a variety of these variables. So currently, the annualized yield annual average yield that we're looking at is around 3.5%, but that has fluctuated between 3.5% and 4%. At times, it's been higher than that, and it's based on a variety of these different data points on the network. But it's all programmatic. That may change in the future. Part of this is that the network is evolving, and there's new proposals to make sure that the staking infrastructure can be maintained long term. So some of these data points may change in the future. Yields may go up, they may go down. There may be limits on number of validators on the network. There may be limits on what the rewards could look like. It's a constantly changing environment. And at 3IQ, part of what our job and our goal is to make sure that we're continuing to educate both our investors and just people in general about staking and how that may impact our products and the ecosystem as a whole.
Yeah, I think that perfectly touches on it. And going back to, again, we stake a large amount of validators. We have some ranging from 2% on an annualized basis to others that are on the 40% annualized basis. So, it's tough to look at one specific number and say that's roughly what you're going to generate, although you have a pretty good idea with large funds because, they have a big enough sample size. So they'll be relatively close to the mean there. So just some facts for you about staking. As I mentioned previously, despite price movements not necessarily always being favorable, staking has more or less gone up and to the right in terms of total number of active validators and the percentage of the network that continues to be staked. You're at roughly 25% of the network, 900,000 validators, and as Chris mentioned previously, 3.55%. That's fluctuated significantly throughout the course of staking. And will continue to do so over time. One key thing that we think here is going to happen is the network is constantly going to iterate, and they're going to set caps to the amount of validators are allowed to be staked. So the first mover advantage is really key here. The fact that our funds already have validators set up means that they're effectively going to be grandfathered in if there is ever, a change to the network that caps it. So we have a serious advantage being the first ETP in North America that offers that.
Okay, so staking versus traditional finance, we've touched on kind of Ether and it being an alternative financial network. I think to draw some parallels to some assets that people may be a little more familiar with that are less crypto savvy, when we look at things like equities, a lot of equities, equity holdings, equity companies in the S&P 500, 80% of them pay a dividend, right? There's yield that gets generated. Same thing with fixed income assets, municipal bonds, government bonds, corporate bonds. There's a coupon payment that gets paid out. Ether is novel, and I think digital assets, proof of stake based digital assets like Ether are innovative and novel in that it is essentially a commodity that's providing yield That commodity, you can think of Ether like oil. I think Greg mentioned this earlier. It's what's used to power the network. You need to use ETH, the token, for these transactions on the network, whether it's buying and selling collectibles, decentralized collectibles, or it's engaging in lending applications on the network, or any application that's built on the network requires ETH to execute those transactions. And so Ether is a commodity. The SEC may have something to say about that in the near future, but that's another topic. And this is novel because this commodity can also generate yield, and staking Ether helps secure the network, and that's an important thing to understand. The more people that stake ETH, it's generally going to contribute to the security of the network. And so people taking this digitally native commodity and staking it and generating yield, it's a relatively novel application, which I think is really interesting.
I think something also to point out here that's really cool about the network is it almost has this positive feedback loop. So as DeFi was really new in 2021, and everyone, it blew onto the scenes, DeFi in terms of lending and in terms of exchanges. And all of a sudden, there were tons of fees that were being generated on the network, which would incentivize more people to stake, to participate in some of those fees, which also secures the network and makes it more decentralized and more powerful of a network, which continues to incentivize more builders to come on, innovate, and create new applications, which again increases the fees, incentivizes more people to continue staking. You see where I'm going with this. So once you have a large enough network effect here, it's almost like a self-fulfilling prophecy in terms of strengthening the network and continuing to build on it.
So this is just a highlight of some of the largest counterparties in the ETH staking ecosystem. We mentioned before there's many third parties that provide different types of staking services. And institutions generally require more institutional grade staking infrastructure. So some of these, like Lido, which is a liquid staking protocol, we won't get too deep into the details of that, but that's more of a retail focused platform. Versus Coinbase has both retail and institutional type services. Coinbase, to be clear, and we'll talk about this a little bit more, they are a main partner of ours here at 3iQ. We were the first ETP issuer here in North America to use Coinbase as our custodian, and they do power all of our staking infrastructure as part of our fees as well. So we collaborate with Coinbase to have dedicated validators for our funds, and we'll talk a little bit more about that in a little bit. But something that is important is ensuring that there's more diversity across the staking counterparties on the Ether network, and so more institutional investors getting involved and using platforms like Coinbase and others, and continuing to distribute the staked assets across different third parties is ultimately good for security of the network. So let's start talking about funds a little bit. Obviously, the SEC Bitcoin ETF approval was a landmark event. I think on a global scale, a lot of markets all around the world look to the SEC and the U.S. market to understand, where the level of comfort is, especially with new assets like crypto. And this has been a 10-year roadmap. To be honest with you, it only happened because Grayscale decided to challenge the SEC's decision of rejecting a Bitcoin ETF, and Grayscale followed a very similar playbook to actually what 3iQ did in Canada. So back in 2016 to 2019, 3iQ spent 3 years and ultimately had to challenge the regulators after getting rejected for a Bitcoin ETP. And ultimately won that decision. And now Canada has been a real innovator for crypto, a regulated crypto products, and 3iQ has been intimately involved in the development of that ecosystem, coming all the way to today, where we're going to talk to you about staking in a regulated ETP vehicle, which is incredibly innovative. But it is a landmark moment. The inflows as a result of this approval have been massive. The ETFs in both Canada, the US, and all around the world, other jurisdictions in Europe, South America, Asia, have started to see much more inflows. And it's kind of that US being a check mark for a lot of other jurisdictions to get them comfortable with investing in this asset class. So incredibly exciting for the asset class as a whole. And I think it's really important to note that, Canada did this 3+ years ago. And so we continue, 3iQ continues to be an innovator in Canada, and we're looking to continue to push innovative cutting edge products to make it easier to access the space and add additional value.
One thing to kind of add there, and this is not, again, not financial advice, not to say Bitcoin is king, Ethereum is king. In terms of the actual launch of the ETF, it's proven to be more or less the most successful launch in the history of ETFs. In terms of new assets that have been brought in, it's over $10 billion already in just over a month. The total amount traded in the past few days has exceeded the SPY ETF in terms of number of trades, not total volume. This is coming from a brand new ETF. It's unheard of, and it's astronomical, the rate at which they are growing.
Yeah. And now the moment everyone's been waiting for. We have like a million questions related to the Ether and the fund structures. Just want to highlight here before we dive into that. The next spot crypto ETF, obviously in the US, is going to be ETH. In terms of what that timing looks like, it's still TBD. The SEC is definitely posturing against a quick approval of any other crypto assets. They made that clear in their approval of Bitcoin. That said, the precedent set by Grayscale with the Bitcoin ETF is likely to be applicable for Ether. So we'll have to see how aggressive the regulators in the US push back on the Ether ETF applications. There's many of them in the pipeline. But one thing I will say, the Ether has been growing over time. Obviously, this chart here shows that since the Bitcoin ETF was approved, Ether has actually been outperforming, and part of that likely is due to the anticipation of an Ether ETF and having a regulated vehicle to make it easier to access Ether, and the subsequent inflows that will result into the network as a result of that. So why don't we dig into our product, if we want to flip to the next slide, which is ETHQ, which is the 3iQ Ether Staking ETF. So this was multiple years in the making, and a huge innovation in ETFs, and Canada, again, leading the way, and 3iQ leading the way. Instead of just having an ETF that just purely holds Ether, what we've done is we took our Ether ETF and we've enabled it to be able to perform staking activities on the network. And we've designed this product, again, hand in hand with Tetra and Coinbase, our custodians, in order to do it in a very institutionalized way. We are still holding all of our assets in cold storage. We are utilizing dedicated validators through Coinbase's infrastructure, meaning the assets are not commingled with any other clients, either retail or institutional. And that's a very sophisticated way to set up this infrastructure. Like Greg mentioned before, we manage a ton of validators in that infrastructure, and they're all dedicated to 3iQ or the Ether Staking ETFs entity specifically. So that's a key point, and we're going to dig into that a little bit more. Maybe we can flip to the next slide, Greg. So talking about what impact this actually makes, how is the inclusion of staking a material impact? And we actually got a question about this, talking about, is the yield enticing enough to bother? Well, if we look at ETHQ versus some of the other Ether products that are in the Canadian market, to be clear, no other Ether ETPs in Canada or in North America or actually in the world offer staking. ETHQ is the first Ether staking ETF, true open-ended trust structure exchange traded fund. When we look at the actual return profile, it actually makes a substantial difference in the price appreciation. And it's a combination of what the actual yield of staking is, so that 3.5%, but then reinvesting those proceeds compounded in the fund and continuing to grow the entirety of the fund. We did get another question about, are those rewards passed through to investors? They're not. The rewards are reinvested into ETH. Actually, the rewards are paid out in ETH. So the Ether actually just continues to accumulate in the fund. So you can kind of think of it like a total return vehicle where all of the staking proceeds are going to continue to accumulate and increase the net asset value of the vehicle. But the actual impact of doing that is that you get substantial performance benefits to the fund where you're going to accumulate and compound returns over a longer period of time. And that innovation is no small feat, and it's not just limited to just the pure yield, because when you take into account compounding over long periods of time, it can make a substantial impact. And many investors are very fee sensitive as well. So when you think about fees of these financial products and the potential that staking yield can offset more and provide additional yield on top of that in our view, that's a substantial benefit to unit holders.
I think the best way to think about it is, let's say 1 share equals 1 ETH. That's not the exact number. Over time, without staking, that one share is going to be worth 0.998 ETH, 0.99 ETH, etc. as it continues to go down and the fees drop on it. You're going to offset part of that, sometimes more than that, with the staking component in there. So your 1 share could actually just be worth more ETH over time, and it's completely net accretive to all shareholders.
Yeah. And a couple more questions that came in. One was, who is your ETH custodian? And this is from Hani. And are ETH fully secure from being lost? So one, our custodian and our staking partner I mentioned before. Our custodian is a combination of Tetra, which is our primary custodian, and Coinbase, which is our sub-custodian, who actually handles the actual cold storage of our Ether and the staking. In terms of our ETH fully secured, again, from a custodian perspective, all the assets are held in cold storage. It's the market standard used across any regulated product. From a staking perspective, there is always a risk of slashing, which is, again, if you have certain downtime or you're not updating your software quickly enough, you may get deducted from the rewards that you're generating and not maximizing those rewards. So it's really important from a design standpoint. So some of the key features you see on this slide, like dedicated validators and transparent reporting, working with a partner, an institutional partner like Coinbase, very well capitalized, publicly traded company, highly regulated, that has an institutional solution that we've built with them for exchange traded products, like ETHQ. That's a big differentiator. And as part of that, there are certain protections like slashing guarantees that we've worked through with our counterparties. That's not to say if there wasn't an Ether-wide type black swan event that we would necessarily be protected. There are always going to be those types of risks, but we do have slashing guarantees around if there's certain amounts of downtime or things like that where we get penalized, that we've worked with our staking providers to ensure that we have protection around those types of instances. I think we have a couple other questions that are very relevant. Do funds need to be locked into the Ethereum fund for a certain period of time? This comes from Mike. So from a manager standpoint, this is really crucial, again, to do this in a really safe, secure way. 3IQ had to spend a lot of time working with the regulators, educating the regulators on how staking works and the controls and processes that we have in place to make sure that we are, one, protecting client assets and doing this in a way that we can continue to ensure liquidity for the funds. So we look at a variety of factors from potential concentration risks to the liquidity needs of the fund and potential unbonding periods. And we manage how much of the fund is going to be staked at any given time. And so those numbers fluctuate, but the short answer is there's no lockup period for investors. Investors can buy and sell the ETF on an intraday basis, on a daily basis. And 3IQ is ensuring that we're managing the staking process to ensure that there's liquidity on a real-time basis with both our market makers and APs, our authorized participants, and with our staking providers like Coinbase. Another question, would staking rewards, this is from Andy, would staking rewards on ETHQ be distributed to ETF holders? I think I touched on this earlier. They are not distributed to the holders. We continue to accumulate additional Ether in the fund. So essentially the net asset value of the fund continues to grow from the ETH rewards that are accumulated. And I think one thing that's worth noting, there's a few questions in here that are of similar nature. You know, when certain upgrades happen and fees change or the yield changes, you know, how do we change the structure? And I think it's really worth noting, you know, 3IQ, we are a digital asset native ETP issuer here in Canada. We're fully focused on the crypto space. And so we're operating at the cutting edge. We're looking constantly, we're monitoring all the different upgrades. You know, you can sign up for a newsletter where we talk about the potential impacts to the network and how we think about that internally. But we manage that process as part of the funds. I mentioned before how we look at a variety of different variables that determine how much we stake or how much we unstake. It's the same thing with these different network upgrades. Greg mentioned earlier that, you know, for example, maybe validators, the number of validators will be capped. If something like that happens, we have to manage accordingly to take into account those new enhancements to the network. But we think we're really well positioned to continue to do that. We are very early to doing ETH staking in a regulated vehicle like this. And so we'll continue to monitor that and communicate with investors as those changes are made. And one question from Anonymous here, you know, does staking ETF overall provide more or less return than a non-staking ETF? I think we already covered that and showed that in the chart on the prior slide. So I think we're good to roll to the next one here. So this is a good example of the total ETH that we've actually accumulated from staking activities, and it's not a nominal number. To date, since we started this activity towards the end of last year, across both of our two Ether staking ETPs, we've generated over 700 Ether of rewards. I think at today's value, that's over, what is it, Greg? $2 million?
Yeah, it's almost 2.5 million.
Yeah, so that's over $2 million of additional performance and yield that's passed through to the shareholders. And I think it's a good time now to just mention, because we've gotten a few questions about is QETH, which is our close-ended exchange-traded product, which is mentioned on this slide. Does QETH also stake the Ether like ETHQ does? And the answer is yes. Both fund vehicles have staking enabled in those vehicles. Of course, the two vehicles do differ in other ways. You know, QETH is a closed-ended fund that trades on the secondary market on the Toronto Stock Exchange, where ETHQ is an open-ended ETF. So there's, depending on the type of investor, one may prefer one or the other. We're not really going to get into too many of those nuances on this call, but happy to answer any questions on that. If folks have them, feel free to reach out. Today's presentation is mostly focused on ETHQ, but our whole suite of Ether products today does have staking enabled. I mentioned earlier the Coinbase partnership. This has been a crucial part to our ability to enable this within our regulated vehicles. Coinbase, again, along with Tetra, we've worked incredibly closely with them to make this possible. They provide both the custody infrastructure in addition to the staking infrastructure for us, and that's really what's enabled this. Having a partner like Coinbase that has a, post FTX, post what's happened over the last year or two in the crypto space, counterparty risk is at the top of mind, especially for a regulated asset manager like 3iQ. We want to ensure that we're protecting client assets to the best of our abilities. And so Coinbase, from a financial position, from a regulatory oversight position, and from a technological infrastructure position, is top of class in the space in our mind. And so we're proud to be a partner of theirs and one of their largest clients on both the custody and the staking side. Another question here in terms of, can you put funds into retirement in a retirement account into ETHQ? Yes, I believe you can. The beauty of a regulated ETP vehicle is that it's available in TFSA, RSP, whatever jurisdiction you're in. Typically in the U.S. IRAs, these types of tax-advantaged accounts are able to trade these vehicles, which makes it very easy. For example, when we talk about staking, if you want to own Ether and stake Ether in a tax-advantaged way, that's going to be really difficult to actually effectuate. So doing that in like an ETP vehicle, it makes it a lot more streamlined. So here's our high-level fund information for those that are not necessarily familiar. The ticker for the 3iQ Ether Staking ETF is ETHQ or ETHQ.U. I think someone actually asked before if those two are the same, like if the Q or .U are the same. And they're two different tickers, but it's actually the same QSIP. You can trade in either US dollars or Canadian dollars. So you have the option to trade in either currency, but it is the same vehicle. Let me roll through some of these other questions. The APR for staking decreases as more ETH is being staked. Consequently, validator rewards continue to drop as more people join the validating pool. You mentioned that it might grow back. In one situation, could that happen? So yeah, there's again, this is very new, and there's a lot of different variables that come into play. The staking rewards on a long-term scale have been decreasing as the network has matured. But I will say it's leveling out. It hasn't been decreasing at the same rate. So we've kind of come into a steady state range here between 3.5% and 4%. Now, there are a variety of reasons why that might tick back up as different financial pressures or innovations come into play. People may look at the cost of capital, and there may be other types of investments that may be more attractive. There may be differences in the actual protocol layer from a reward standpoint, where they either cap number of validators or they change the way the incentive structure works. I can't definitively say that it's set in stone and that it will only ever go down from here. I think there's always a possibility that it goes back up depending on those forces. But Greg, I don't know if you have any other thoughts on that one.
Short term, I think the biggest driver of it is going to be transaction fees. I always like to say that blockchain hasn't had its quote unquote Fortnite moment, if you will, indulge me on that. Something where everyone has to use the Ethereum network, and it's part of a large demographics everyday life. The second that happens and people are providing Ether, again, the input to interact with it, transaction fees are going to skyrocket. And in a sustainable manner, again, if you have something that needs to be part of every single day of life. So going back to the banking aspect, the question that was asked, are banks going to become obsolete? Over time, if Ethereum or any blockchain network starts taking over some aspects of banking, then the transaction rewards from that are going to be passed on to everyone that's validating this quote unquote new banking network. So there are a lot of factors that are going to drive the network rewards as the network continues to be innovated on.
Yeah. Yeah. And we got another question. This is a really great question here from Pascal. What is the ratio of staking of your fund QE versus ETHQ? So again, this is a bit of a nuanced question. And the amount of staked assets in either fund will vary depending on those variables I mentioned earlier, like what type of liquidity needs there are, what the unbonding periods on the network look like, etc. That said, as a general rule, QE, which is a closed-ended fund, which only has annual redemptions, it has monthly redemptions, but it has monthly and annual redemptions. But the ETF ETHQ has daily creations and redemptions. So of course, the liquidity profile from a manager standpoint is going to differ slightly. So we're likely always going to be able to stake more, or at least currently, we're going to be able to stake more ETH in the QETH vehicle, our closed-end fund, because the liquidity requirements are lower. That said, ETHQ, we are also staking a majority of the assets, and our goal, again, as 3iQ, as we continue to innovate in this space, our goal is to try and get both funds as close to 100% of the assets staked in a way that we can, while maintaining the appropriate risk management protocols that we need to, and ensuring that we're providing liquidity for investors. So over time, we're hoping to grow both of those funds towards 100%, but at any given moment, the amount of the funds that are staked may vary depending on those different inputs, the different liquidity needs of each vehicle. But again, over time, we're hoping to continue to innovate in this space, continue to collaborate with the regulators, and be able to provide as much staking yield as possible in a safe, secure way for investors.
I think that also brings up a very interesting point. We've touched on this multiple times during the presentation. Ethereum is constantly iterating, being innovated on. There's a huge pool of developers that are working on it. It's a little bit different than a Bitcoin ETF, where things are constantly moving here. And there's an opportunity if you are at the forefront, if you are a native digital asset manager that is looking to innovate with their ETF, to continue to be ahead of the competition. So I think 3iQ has done a great job of that so far with staking. We're going to continue to be aware of anything new being added to the protocol, any way to enhance the amount that we're staking while understanding our liquidity requirements. And this is an opinion. I don't want to necessarily speculate, but there will be a time when an Ethereum ETF is approved in the US, and it certainly at the start won't be with staking. It's going to be a walk before you can run. And fortunately, in Canada here, we've had regulators that have been open-minded and somewhat easy to work with.
Yeah, so if we flip to the last slide, which just has our contact information, please feel free to reach out. We're going to continue to do these webinars regularly. We had great engagement today. I appreciated all the questions. One final question here in terms of the management fees. We waived the management fees on ETHQ, so they've been zero to commemorate the launch of staking until the end of March. We will announce after that period ends. By default, the management fees are 1%, but after that period ends, there's the possibility of continuing to extend fee waivers, but more to come on that, and we will communicate that to the broader market in time. So with that, I think we're at the hour mark. Thank you so much for all the questions, like I said, and there have been a ton of questions with an Ether wallet. We will review all the questions and we will send some of the top questions, some Ether after the presentation. Really appreciated the engagement. And if any of your questions weren't answered, please feel free to reach out to us at info@3iq.ca. We'd love to continue the conversation and help you better understand our product suite or just staking in general. Amazing. Thanks, everyone.
Thank you.